Hey everyone, Jason Seibel here with Innovative Home Loans. I know it's been about 6 weeks, but the market's been pretty crazy, and I just want to get everyone up to speed with what we are seeing across the board. And this video is going to be about the impact of forbearance, which was the last video, on lending. I said so. Let's go ahead and hop in. So, the CARES Act of 2020 was passed back in March. And what we've seen is stimulus checks. We've seen the economic injury loan and the payroll protection program be rolled out by the SBA. And then the other huge part of this was forbearance. And let's talk about what forbearance looks like. So per the CARES Act, lenders have to offer 6 months of forbearance, and it can be extended to 12. Payments need to be caught up when this period is over, and your options to do that are to either pay the balance in full, to request and hopefully seek a modification from your servicer if they'll offer it. If you can't pay it in full or modify, your next two choices are to sell and take your profit. Last case, your last option would be to foreclose, which isn't a real answer. But this created some serious unintended consequences overnight by the government stepping in and doing this, because it was on the honor system. Anybody could apply for it, and nobody was really ready. So it's kind of like a Rubik's Cube here, like you see the picture below. It may fix one thing, but it impacts 3, 4, 5 things trickle effect down the road. So in this case, the loan servicers really got squeezed overnight. Servicing values were just slashed in the secondary market, meaning the value of loan servicing, what people were paying, it just wasn't worth that anymore. And at the end of the day, it's going to cost the customer in the long run. So let's talk about the loan servicing model. Okay, so it's very similar to a big property management, apartment type building. So you've got tenants. Those tenants pay a superintendent, and then that superintendent forwards those payments to the owner. So the loan servicing model is the exact same way. You've got homeowners who pay a servicer, and then that servicer forwards or makes bond payments to the bond owner. The problem in this model is, regardless of whether the homeowner makes the payment or not, the servicer still has to make the payment to the bond owner. And it just does not take long for it to be a math problem. So the servicer impact on this, as of now, approximately 8% of all mortgages are in forbearance, and it's expected to peak up around 10%. And that's roughly $1 trillion in principal balance of loans nationwide, which for the servicing industry causes a massive liquidity problem. And here's the math problem. 2019 loan servicing revenue was roughly $10 billion. The monthly forbearance cost per the CARES Act that's costing these servicers is about $6 to $8 billion a month. So not only are they not going to make any money this year, but they're having to dip into reserves if they even have it at all. So the loan servicer's response to this was, well, they came out and said, okay, well, if we were paying a lender 1% fee to service a loan, well, now it's half, or now it's maybe a quarter. They asked Congress for a facility to cover these payments long term, so it just didn't go into perpetuity. And then they refused to buy loans from lenders that were in forbearance. So once that happened, then that impacted the lenders. So that hit their profitability, their credit lines were impacted, and their ability to model risk in terms of pricing. So here's the lender math problem. And there's really two. If I have $1 million line of credit and I fund 4 loans a month at an average of 250,000 loans, typically speaking, in a normal world, you could sell that loan, close on your credit line, get it sold to the servicer within about 10 days. So if you turned it 3 times a month, you could fund $3 million of loans on a $1 million line. Well, now we're in today's world. And let's say one of those loans is a default. So if you can't sell it to investors, that loan has to sit on the line. And now, because servicers are concerned, they're doing their due diligence, and you're seeing doubling, tripling, and sometimes 40 days to get a loan off a line. So now on that same $1 million line of credit, maybe you close $1 million in funded loans a month. So your cost stays the same, but now it basically got double or triple as expensive per loan because of this. So then everybody's like, oh my gosh, we need a better path. We need a plan. So, we had government intervention. Ginnie Mae, who insures FHA VA loans, rolled out a facility to advance monthly payments to protect servicers. And then after a lot of heat, but that solved government loans, nothing for conventional. And then after a lot of heat, Fannie and Freddie came out and said, okay, look, after 4 months, we'll go ahead and backstop this, and we'll pick up we will advance payments after 4 months of forbearance. And then the next step was the default piece, and Fannie and Freddie came in and said, look, we will buy first payment loan defaults, allow them to go into the mortgage pool, but it's going to come at a steep cost. 500 basis points or 5% per loan on a first-time buyer and 7% on a repeat buyer. So that triggered the next lender math problem. So the average profit margin per loan historically is about 0.5%. So a $300,000 loan, that'd be $1,500 that the lender makes in profit across everything. So now the servicing value is getting hit, so that's impacting profitability. And now you've got payments in default that was completely unexpected due to COVID. Now it's 5 to 7% to sell that loan and get it off your line to be able to create liquidity and close loans. Massive problem. So the lender's response to this has been, hey, we're going to spread the risk over the entire loan pool. So if 1 in 10 loans is going to go into default and it's going to cost me 5%, we are going to pare that out and charge the customer roughly 0.5% on every loan, and then the one that fails will have air cover. And additionally, they've tightened guidelines, eliminated products, and then they've added this extra layer risk-based adjustments for items such as lower credit scores. If you want to pull cash out, they're basically charging extra to be able to do that because those loans are deemed as having a higher propensity to go into default and forbearance. It's a lot to process, but the bottom line is mortgage bonds have stabilized. So in my last video, we talked about capacity and margin calls, and it was created with all this volatility here. And you look, since March 30th, it's been pretty stable. So those issues have been resolved, but this forbearance piece, created the next layer and the next wave to address and fight and solve. So what's going to happen next, in my opinion? Capacity and margin issues have been resolved. The next shoe to fall is servicing, and the Fed is committed to buying mortgages as long as necessary. And what I'm seeing is lenders are really waiting for the country to start opening back up so they can finalize their risk modeling and bring pricing back. If I trip back here, interest rates aren't very different up here than they were down here, and that just comes to do with the modeling of risk. And once items become known, they're going to be ready to roll, and they want to make loans. So the bottom line is this: we are in a unique place in history, and this is a financial and mental marathon. I want to give a shout out to my peak performance coach, Jonathan Roach, because we chat about this weekly. But the coronavirus is really a marathon, and we just need to make sure we're taking the time to recharge our mental battery, to maintain our health, sanity during this time, and continue to stay the course. And understand that my door is always open to strategize and help review your situation just in any type of consultative way that I can bring value and help. Over the last 6 weeks, I've probably talked to about 200 clients, and it's just awesome to get into the weeds and be in a position to help answer questions, problem solve, to get you all through this time. And my last note on this is adversity is preparation for greatness. There's a lot of shifting going on. I look back, I have not eaten a meal out, nor has my family, in the last 8 weeks. That's something 2-3 times a week. So yes, that was a shift. What that did is that freed up capital to be able to save and do different things. Both my kids are getting ready to go away to school in the fall. They're taking turns learning how to cook. So in times of adversity comes opportunity to take advantage of those things and take lemons and turn them into lemonade. So if you have any questions, reach out to me by phone, text, or email. But otherwise, so long for now, and I will be putting out a video next about the economic impact of all this shortly. All the best.